more and more companies are financing themselves privately on the equity side.
Yeah.
Same thing's happening on the credit side.
Coming up on the bridge, we're about to talk to Jack Weingart. He is the CFO of TPG, which is one of the bigger private equity firms in the world. For TPG, it's less about what's happening in public markets, even though they're public themselves, and more about the value creation in private markets that are continuing to expand despite all the talk about IPOs. Welcome to The Bridge by iCapital. I'm Sonali Basak, the Chief Investment Strategist at iCapital, and today I am joined by Jack Weingart. He is the Chief Financial Officer at TPG, behind some of the biggest names in the market this year that you'll be hearing about. And he has spent 20 years at TPG, really a pioneer in a lot of the private equity investments that we think about today, but also really having expanded into different areas of private markets. We're going to talk about all of that. But first, because, Jack, you started your career at TPG in capital markets, I would love for you to comment on what 2026 means to you when it comes to the capital markets, this pretty unprecedented IPO market that we're looking at.
It is. Well, first of all, thanks for having me, Sonali.
Thank you.
It's a pleasure to spend time with you. As you said, I joined TPG as a partner 20 years ago to create our capital markets business, which really means working with our portfolio companies to help them manage their balance sheets on both the debt and the equity side after we acquire them. And that includes, in some cases, using the IPO market to exit our investments. So we follow the IPO market pretty closely from that perspective. This is an unusual year in the IPO market. We're going to have, I think, the biggest year on record until this year was 2021 with about 150 to 170 billion of issuance. And this year, the three most talked about companies will probably exceed that amount collectively with just the three. So it'll be a very big year in the IPO market. It's an unusual year. We're not going to see a repetition of that, I would expect, for quite some time.
Why are companies staying private for this long? Why wouldn't they go public sooner?
Well, that's a good question. And it's one of the things we like about the private markets is the vast universe of private companies that we have access to invest behind and the increasing percentage of value creation coming from the years that companies choose to stay private longer. It's funny because for most of my career, investors have asked, our LPs have asked, and others have asked us, isn't there too much money in private equity? Hasn't too much money been raised? Is there too much dry powder for you to be able to invest that well? Well, along with the raising of more capital, and in part because of the raising of more capital, more and more companies are choosing to stay private longer.
So what does that mean in terms of, exit opportunities? What is the way that you create value at the end of the day after the hold period? Is it mostly M&A these days?
If you focus on the companies that we were just talking about who will be going public this year most likely, and compare that to comparable companies historically, Google went public in 2004, I believe, about 20 years ago. When they went public, they had a $20 or $30 billion market cap at IPO. Within 3 years, that market cap had gone up 10x. Today, that tenfold increase in equity value is increasingly happening, and certainly in the case of the three companies we're talking about, happening while they're private. So for investors to have access to that rapid growth phase of many companies, not all will wait till they're trillion-dollar companies to go public, but many who would have gone public when they were $1 billion companies will now wait until they're $10 billion companies to go public. And that's in part because there's a vast amount of private capital available to help companies grow while they're private. It's in part because in many cases, it's a better way to grow, to stay private and think about investing for the long term before you go public. And it's also correlated with the fact that the public markets have increasingly become the domain of larger and larger companies. So it's much more difficult to be a publicly traded company with a $500 million market cap than it used to be, because more and more of the public equity investment capital is oriented, indexes and otherwise, around larger and larger enterprise value companies.
So this is a really fun conversation to have with you in particular, because you were part of the story for TPG in terms of its own IPO.
Yeah.
So why be public these days?
If you look at the history of our industry and the larger players in private markets like ourselves, we were one of the last to go public. Like some of our peers went public dating back to 2007, 2008, shortly after I joined TPG, actually. And we made a concerted decision not to go public back then and waited, and we're very happy operating as a private company. And we grew quite a bit as a private company. We eventually chose to go public because having access to public capital, public currency became more important to us. For many years, our industry was very non-capital intensive. We would invest a lot of our personal money alongside of our LPs, but over time, the strategic importance of a balance sheet increased significantly. Now, by the time we went public, we had grown quite a bit. So in some ways, we are an example of what I'm talking about, choosing to stay private longer.
Very interesting. So when we think about kind of the evolution of capital markets here, it's interesting that you say you joined TPG kind of after 2008. A lot has changed.
Actually, I joined in 06.
06, so right before 2008. But that was kind of a flashpoint in private markets, right? After 2008, you saw a lot of activity move out of the banks and into private markets. And we started this conversation by talking about TPG's private equity expertise. But you then, years later, bought a private credit firm. You've expanded into different areas of private markets. How does private credit and private equity interplay for you guys?
Well, it's an interesting question because what we just talked about in private equity and the evolution of private and public equity with companies having access to more capital through private equity and therefore choosing to stay private longer before accessing public equity capital, in some ways the same transition is in the middle of happening or already has happened in credit. Right? There's a lot of talk about private credit, how much the private credit industry has grown. If you look at how companies are financing themselves, increasingly they're financing themselves using private credit instead of public credit. So the same trends we've seen in equity capitalization have happened and are continuing to happen in the credit markets.
So what do you make of 2026 from the private credit perspective? Because obviously the first quarter of this year was a kind of more challenging period relative to what we've seen in the last few years of explosive growth for the industry. So where does it go from here?
Well, it's been challenging in some ways and less challenging in other ways. I look at fundamentals and technicals. On the fundamental side, things continue to be, if you look at our private credit business, very strong. Our performance numbers are strong. Loss rates are very low. PIK rates in our portfolio are very low. The underlying health of the portfolio companies is very strong. We haven't seen a fundamental credit cycle. I mean, default rates have picked up a little bit, but not much. So fundamentals are very strong. Technicals, particularly for those who raise more of their money from private wealth investors, from individual investors, in structures that allow for redemptions, have seen some technical disruption for sure, with increasing redemptions by individual investors. We haven't seen that on our side, but I think that is the root of some of the challenges in the industry is capital flows.
So it's interesting because to the point that you're making, institutional flows have still been very strong.
Yeah.
And the question then becomes, what are the institutions seeing that the individual investors are not?
Well, I think the individual investors and institutional investors have really seen many of the same things. What's causing some of the outflows is nervousness about the underlying credit quality, not nervousness about necessarily current defaults, but forward indicators about potential risk in the portfolios. Our institutional investors look at our portfolios very carefully, and whether it's us or some of our peers, institutions continue to find private credit to be a very interesting asset class and continue to allocate to it. So I think we'll see in the next credit cycle what defaults bring, what recovery rates are, what ultimate performance looks like. But in the meantime, you'll see capital flowing from both individual and institutional investors in different ways.
Yeah, I think what a lot of people are missing is that there's something structural happening here. To your point on companies staying private for longer.
Yeah.
So it's interesting. I enjoy asking you this particular question too, because before you were in the financial industry, you were an engineer. Yes?
A long time ago.
Yes, yeah. But, as an investor in this industry and a lot of these new technologies, a lot of people, you had mentioned the technical questions and concerns about potential defaults in the private credit space, but really also software and AI and the concerns about the disruption that will be seen. You guys have a front row seat to this disruption, actually. What do you think that investors should really take away by the way AI will make a difference for the better and the worse for certain companies?
Yeah, look, I think generative AI, agentic AI, the development of, so what's fueling all of the interest in OpenAI, Anthropic, the IPOs we started talking about today, is the fact that they are fundamentally disrupting industries in ways we haven't seen in my entire career. We've seen disruptions for sure, but the degree to which this disruption is happening, the speed at which these companies are growing, is pretty unprecedented. And I think that is a sign of the fact that companies across industries, not just in software, are going to be using AI to create efficiencies in their business, and people focus on software. And it is true that one of the first use cases of agentic AI is replacing what used to be done, the coding that used to be done by individuals. But that's one small example of ways that AI can be used to improve business processes. For us, it's really an opportunity. If you think about what we do in private equity, it's fundamentally, we consider ourselves to be transformational investors. We try to acquire good companies in good industries with long-term macro growth opportunities, but then bring our operational expertise to the table to help companies improve what they do, to accelerate growth. If you look at what's driven our value creation in private equity, 75% of our value creation has come from revenue growth and margin expansion, i.e. earnings growth, not from traditional financial engineering, not from just using too much leverage to amplify earnings growth. It's working with our companies to grow earnings faster under our ownership.
So,
and we've used all kinds of operational tools to do that over the years. And the biggest tool we've ever seen
is AI.
Is AI.
Well, that's what I was going to ask you exactly. To what extent is AI fueling that earnings growth across portfolio companies?
I would expect it to fuel it more, and we're seeing the beginning stages of that. But we're in the very early innings of enterprises using AI to become more efficient, to both drive faster revenue growth and to become more efficient on the cost side. So I think to date, very little of the earnings growth has come from using AI. Going forward, we expect a lot more of it to be used, not just by software companies, by business services companies, by consumers. Any company that in addition to coding, does tasks for other enterprises where agentic AI can be used to make those tasks more efficient, will be using AI.
Well, my question was, the crystal ball question. What are the industries that are going to really feel the weight of AI that investors are not accounting for yet?
I think every industry is going to be using AI in different ways. And when you say feel the weight of AI, in any given industry like software, the dispersion of outcomes across investing in a sector is likely to be wider going forward, in part because of the impact of AI, both positively and negatively. There's a lot of focus these days on the potential negative impact of AI. We're focused both on protecting the downside in thinking carefully about those potential negative outcomes, but more interestingly is focused on the positive side, because the dispersion will be wider on both sides. And I think what any good investor has to be doing right now is, when you think about that dispersion of outcomes, reducing the risk on the downside tail, but also finding ways to leverage AI to drive more positive outcomes.
It just feels to me that if you're a private markets investor these days, you can't not have an AI strategy.
I would go further than that. I would say if you're a private markets investor or a public markets investor in all asset classes, you have to have a perspective on AI as part of how you invest.
So let's talk about software a little more here, because to your point on the dispersion of outcomes, it just seems a little implausible to me that all software is dead from AI, especially if what you're saying is margins can improve here with the ability to use AI to code better, faster. So, what are people not seeing about the software story in particular?
Well, margins can improve and revenue can grow faster, because the penetration of AI in the enterprise is creating more need for some of what software companies do. It's certainly true that if a software company's fundamental value thesis is helping coders code, those business models are under threat, right? If, on the other hand, like one of our portfolio companies, a company helps enterprises through cybersecurity risks, helps protect the databases and applications of a company against threats. Those threats are increasing significantly. with the use of agentic AI. Think about the AI agents people are talking about using to create efficiency in the enterprise. Those are only as good as the data you give those agents access to. So what that means is in any enterprise, iCapital, TPG, we're going to have lots of non-humans accessing our corporate data, i.e. AI agents. How do you protect your data against those agents? You do it with software. So our security software portfolio is seeing accelerating growth because of the opportunity to help enterprises protect themselves against that increasing threat.
So you did a really nice job articulating the qualities of some of the companies that will make it through this cycle and even gain from a lot of this new technology. But what about the companies that may not make it? What are the qualities of companies that are perhaps not moving fast enough to meet the moment?
Well, I think the qualities are they're not moving fast enough, because any company in any industry needs to be thinking carefully about AI and moving quickly in that direction. So I think we're going to see over the next several years in every industry examples of companies that don't in fact move fast enough. If you start with the thesis that in any given industry, outsourced business services, software, companies can use AI to transform. You have incumbents in that industry who have incumbent customer relationships, who are already doing whatever they do for customers. What they're doing can be made more efficient with AI. It's certainly true that an AI startup could displace them, but if the incumbent uses its access to data, its proprietary position with its portfolio, with its customers, to transform what they're doing, as long as they're moving quickly enough, they're going to be the ones capturing the benefit and retaining those customer relationships. It's the companies that don't move quickly enough that maybe create an opportunity for a new entrant to take over their incumbent relationships.
So one question I had is, just like 2008 was kind of that flashpoint for private markets, a meaningful growth that came out of that. You could say for the technology industry, that flashpoint was 2022 with the advent of ChatGPT. And there are a lot of people, you guys saw it early, right? But there are a lot of people who got to 2026 and just started seeing it,
Yeah.
And so if you haven't been adopting this for years, then are you kind of left for dead here, right? I mean, is it too late to get started?
I don't think so at all. Enterprise AI adoption is still in the first inning. The AI models have become, and the agentic opportunity has become much more robust as companies like Anthropic and OpenAI have developed more and more robust platforms. But the adoption of AI, the true adoption of AI by enterprises is still very early. We just announced an investment very recently in partnership with OpenAI where we're together creating what we're calling DeployCo, or a deployment company. And the whole purpose of that business is going to be to create a next-gen business services company to hire and acquire forward-deployed engineers to work with companies across industries to adopt AI. And the fact that that company is needed is an example of the fact that I think Sarah, the CFO of OpenAI, talked about seeing a vertical wall of demand from enterprises for their technology. To meet that demand, what's required is engineers to work with those companies to take advantage of AI.
It's interesting. We were kind of talking earlier about how you were an engineer before you came into finance. Now we're talking kind of more about the skill sets needed for the future. I think this is a relevant conversation where a lot of the world is so worried about what AI is going to do to the workforce. You've also had a lot of different hats at TPG.
Yeah.
So it's worth asking you, what are the skills of the future? You have so many portfolio companies. What do you need to see from people to kind of fit into this new AI economy?
Well, I think and I see this a little bit personally because 3 of my 4 kids are software engineers, and they still have jobs. And in fact, their jobs are getting more interesting because they're not having to do some of the basic coding. They're able to step up a layer or two and be the ones kind of working with models to do some of that coding and be the ones tying that together into solutions. So I think in the coding example, and I think this cuts all the way through how we educate kids. We should no longer be educating kids as software engineers to be coders. They have to think more about being systems engineers. to work with models to do some of the basic coding, but then tie it all together into solutions.
This is very selfishly a nice thing to hear because I did learn to code. I never remembered anything I learned. But you could be successful without learning those skills, is what you're saying at this point, if you want to have a successful career in technology or finance.
Or transforming those skills into one or two layers higher. Like one of the most scarce jobs out there today, jobs in greatest demand, is a form of software engineering called forward deployed engineering, which are people who understand how to work with AI, who are AI experts, but also understand business process and can go into any industry, understand the workflows in the industry, and utilize both that understanding and their AI expertise and their coding expertise to tie all that together into solutions.
So it's interesting, when you came into this year, right, we have seen not just these potential for massive IPOs in 2026, we've seen massive fundraisers on the heels of those IPOs in both equity and debt markets. Completely unprecedented. A lot of people look at this and say, well, okay, when does the train stop? Is there anything that can kind of stop this trajectory of massive capital deployment in an industry that needs it? What keeps you up at night? I mean, is there anything that can kind of halt the trajectory that we're on?
Well, I think what ultimately stops any wave of capital raising is questions around the returns on that capital. So I think over the coming years, there will be a lot of attention paid to that ROI question.
So do you worry about the ROI on AI?
I think any good investor has to worry about ROI in every industry they invest in.
Okay, so
we're watching it closely.
CFO hat then. One thing I'm kind of obsessed with is the token economics of these companies. Do you think that the economic model changes over time?
I think as the CFO of a company, we work actively with our portfolio companies to help them improve what they do, including using AI. We're, of course, also looking at how we use AI internally to transform how we work, right? As a CFO, I keep a pretty close eye on that token cost, on what we're paying for that, and make sure that we're getting a good ROI. So I think that'll be the balance every company looks at. Is there's an urgency to any company thinking about how to use AI to transform what they do. There's also a countervailing balance of how much you're willing to spend to drive that. So having good discipline internally, whether it's internally at TPG or helping our companies have that discipline to target specific business processes and to have a target ROI based on how much you think you're going to have to spend and then drive toward that ROI, as opposed to spreading the peanut butter too thin and allowing every employee of the firm to have access to these expensive tokens.
So
now on the AI companies themselves, of course, I think as those companies mature, they'll come up with different ways to generate revenue, and it won't be just through tokens. I think you're already seeing some of that.
Right. You know, history of software will show that usage-based pricing is always given way to seat-based. And I'm wondering if we're sitting in that kind of moment again at some point, that there is just going to be more leverage that is given to the buyers of AI rather than the makers of it.
Could be.
One day.
Yeah.
One day.
Yeah.
We're not there yet. Maybe not anywhere close to it based on what we are seeing in terms of how much more expensive some of these models are getting.
Well, I think today what you're seeing is the opposite,
Right.
which is these companies are becoming more and more important to everyone who uses them, whether they're individual use cases like myself, relying more and more upon some of these companies to answer questions I have, to do analysis I want done, or in the enterprise. They're becoming more and more important.
So some predictions from you. So as somebody who's kind of lived through the evolution of capital markets, when you look at this year, you know, what are some things that you expect out of the IPO market this year? What are some things that investors may not be understanding about the way these companies are coming to market?
Well, look, I think back to the beginning of the conversation, this is an unusual year in the IPO market. So the headlines will be driven by the very large IPOs that we've talked about. People shouldn't expect that to be an annual occurrence. We'll go back to regular way IPOs. If you look back at the public versus private equity markets, the trend has actually been the opposite. These three companies are a bit of an exception to the rule. In some ways, they're an example of companies choosing to stay private longer. If you look at how big they've gotten before going public. if you look at the total private company universe, it's grown substantially.
It's almost 14,000 companies.
Yes, while the number of publicly listed companies has shrunk during my career from something like 8,000 publicly listed companies in the U.S. down to 4,500. So it's been almost cut in half. So this wave of IPOs this year partially reverses that trend for a year. But longer term, I think you'll see the same trend play out. And what that means to us as private markets investors is the universe of companies available to us to invest in continues to grow. And I think for any client of ours, whether it's an individual client or an institutional client, they want access. They really need, as equity investors, forget about public versus private. As someone who wants to benefit from investing behind equity value creation, you really have to do that through both public equity investing and private equity investing.
It's interesting to that exact point that you're making. I think something like in the last 25 years, there are half the amount of IPOs that were in the 25 years before that. And so my next question for you on predictions is, if we fast forward 10 years from now, we said there's almost 14,000 private companies today. What do you think that number looks like in 10 years from now?
It's larger.
Like double?
Probably.
Yeah.
In part because the innovation opportunity from things like AI is even greater. So the ability to create new companies is greater today than it was historically. Not all those companies will succeed, but I think over the next 10 years, you'll see greater innovation and acceleration of innovation, in part because of the trends we're talking about. And that will lead to more private companies.
Final prediction. We were talking so much about AI and generative AI. What is the next big technology you're excited about?
I have no idea.
What's the next big winner?
It's hard to predict the next AI.
Yeah. You're not going to try?
No.
No? Okay. Well, we'll keep an eye out on where you're putting the dollars, because I'm pretty sure that is a little bit behind what you expect is going to win at the end. Jack, thank you so much for joining us. That is Jack Weingart. He is the CFO of TPG, and you've been watching The Bridge by iCapital.